Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing ZIM stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. ZIM is one of the largest shipping companies in the world with 113 vessels. The main way ZIM makes money is it leases out its vessels to companies that need to transport stuff across the ocean. For example, it recently agreed to lease 15 vessels to Seaspan Corporation to transport LNG across the ocean. LNG stands for liquefied natural gas. This is natural gas that has been cooled to a liquid state. It is cooled down to negative 260 degrees Fahrenheit for easier shipping and storage. LNG is 600 times smaller than its volume before it is cooled down. In March 2021, the company reported its biggest profit in its 75-year history. The company is headquartered in Haifa, Israel, and was founded in 1945. It also has headquarters in Norfolk, Virginia. The stock trades on the New York Stock Exchange and Deutsche Börse. Let's get started with the model. This is a mid-cap company, 7.3 billion market cap. They're trading at $62 a share, and they have 119 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. And their free cash flow went from 200 million to 3.6 billion. That is just a massive leap. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that was negative in 18 and 19, jumped up to $500 million in 2020, then way up to 3.3 billion. Just unreal growth. Revenue is the sales for the company, and that grew from 3.2 billion to 8.6 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is cost of revenue. These are the expenses directly related to generating the revenue. The cost to maintain the vessels is part of cost of revenue. Revenue minus cost of revenue gives you your gross profit. And look how much that grew from 148 million to 4.3 billion. Below that is our operating expenses. Depreciation is an operating expense for this company. Gross profit minus operating expenses gives you your operating income. And that went from 6 million to 4.1 billion. They went from Little League Baseball to the major leagues in only 3 years. They spent 167 million of interest on their debt, which is the most they've paid in a 12-month period. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. Below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income, which was negative in 2018, way up to 3.3 billion. This is the company's income statement from their latest quarterly report. This shows us 2020, the third quarter of 2020, the third quarter of 2021, the first 9 months of 2020, and the first 9 months of 2021. In the first 9 months of 2021, their revenue is 7.3 billion. It cost them 2.9 billion to generate that revenue, plus 514 million of depreciation. They have lots of depreciation because the vessels are fixed assets that they have to depreciate every year. Their gross profit is 3.9 billion, which is 10 times as big as last year's number. Their gross margins are 53%. That's gross profit over revenue. The median in the industry is 45%. The average is 43%. That's out of 34 companies. So they're a little more profitable than the average company. General and administrative expenses was 184 million. Their operating profit is 3.7 billion, up from 282 million. It looks like they're adding debt. They had 132 million of interest on their debt. Last year was 115 million. And their net income went up from 158 million to 2.9 billion. In all of 2020, it was $500 million. And just in the third quarter of 2021, it was triple that, 1.5 billion. Their net margins are 40%. Anything above 20% is really good, so 40% is just unreal. The median is 4% and the average is negative 5%, so they're crushing it. This shows us their trailing 12-month EBITDA. So in the trailing 12 months as of Q3 2021, it was 4.8 billion. And you could see it just goes up every single quarter. And their net leverage is 0. It went from 5.3x to 0. Leverage is how much debt you have. The reason it's 0 is because they have enough money on their balance sheet to pay off all their debt. Here's their shipping volume by location. This gives us thousands of TEUs. TEU is 20-foot equivalent units. A 20-foot unit is a shipping container. That's how they measure volume. In the Pacific was 362,000. The Cross Suez Canal 87,000. In the Atlantic part of the world is 144,000. Intra-Asia 243,000 and Latin America 48,000. So you can see their volume has not increased much. The shipping rates have increased a lot. That's why their revenue is so high. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So you could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So you can see they generate positive cash flow every year. Even though they had negative net income in 18 and 19, they still generated positive cash flow. But look how high it is in the trailing 12 months, $4.4 billion. They spend a lot on CapEx in the trailing 12 months. Every time they buy a vessel, that's part of CapEx. Then they carry that vessel on their balance sheet and depreciate it over its useful life. Operating cash flow minus CapEx give you your free cash flow. And they have tons of free cash flow. That's why they pay a really high dividend. It looks like each year they're decreasing the amount of debt they have. In the trailing 12 months, their CapEx was $781 million, and their investing cash flow was over $1 billion. CapEx is part of investing cash flow. The difference may be the acquisition of a company. This is their operating and investing cash flows from their latest quarterly report. The statement of cash flows has 3 parts: operating, investing, and financing. We'll look at financing in a little bit. And this shows us all of 2020, the third quarter of 2020, the third quarter of 2021, the first 9 months of 2020, and the first 9 months of 2021. So operating cash flow starts with your net income. That was $2.9 billion. Then we add back the non-cash items on the income statement, $530 million of depreciation, $122 million of net finance expenses, $636 million of income taxes. Because the income taxes on the income statement are not the taxes the company pays. That's the taxes according to the accounting rules. It looks like they actually paid $23 million of taxes. We also have to adjust for changes in working capital. It looks like they extended a lot of credit, $695 million. That's a cash outflow. They reported an accounting profit of $3 billion, but actually generated $4 billion of cash flow. In their investing section, it looks like they acquired some companies. They spent $755 million in acquisitions. In their investing section, they had a cash outflow of $1 billion. Last year was a cash outflow of $13 million. This is the financing section from their statement of cash flows. They paid down over $900 million of debt. They paid their common shareholders $237 million of dividends. In their financing section, they had a cash outflow of $1 billion. Last year was a cash outflow of $286 million. This is the equity section on their 9/30 balance sheet. They have $3.2 billion of equity. They raised $2 billion from selling their business, and they profited $1.2 billion from running their business. Let's look at the capital structure. $3.2 billion of equity, $2.8 billion of debt. They're 53% equity, 47% debt. But they could pay off all the debt with the cash on their balance sheet. Ironically, they have almost exactly the same amount of cash on their balance sheet as their debt. This is the first time I saw it like this. It's not exactly to the dollar, but it's pretty close. I gave them the lowest whack on Finbox, 7.2%, and that's a discount rate we're going to apply to the future cash flows. We estimated a little over 3 years of future free cash flows. We also estimated a terminal value, which is all cash flows past 2024. That's $32 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $29 billion. We divide that by 119 million shares. And we get a calculated stock price of $243. They're trading at 62, so they're trading at a 75% discount. It's a really strong buy according to the model. Their revenue is projected to decrease 12.4% annually. That seems pretty unlikely, but I kept it there. And even decreasing their revenue 12.4% for the next 3 years, I'm still coming out with a stock price a lot higher than they're trading at. The way I calculated their future free cash flows, I needed to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers, and then I divided by these 4 revenue numbers. And that's 26%. So I multiplied their future revenue estimates by 26%. That's how I got their future free cash flows. Simply Wall Street values the company at $218. They're saying it's 73% undervalued. 3 analysts priced this stock, and the average price target is $66. The low is $43, the high is $80. The stock price has only gone up since it IPO'd last year. The stock has more than tripled in the past year. Just amazing growth. In the past 52 weeks, the stock has gone up 417%, while the S&P is up 15%. The 52-week low is 11, the high is 65. The stock is on a major uptrend, trading above its 50-day and 200-day moving average. About 4 million shares are traded each day on this stock. Of the 119 million shares outstanding, 81 million are on float, 45% are held by institutions, and about 5% of the shares on float are shorted. Lots of people are jumping into this stock for the dividend, 16% dividend yield. Their last dividend payment was $2.50. And it looks like they can easily afford the dividend. It's only 36% of their net income, 33% of their free cash flow. If you invested $10,000 into this company last year when they IPO'd, you'd be handsomely rewarded. Your $10,000 will be $54,000 today. 46% of the shares are held by institutions, 26% by private companies, 22% by the general public, and 6% by public companies. Their biggest shareholders, Cord Investments at 26%, then Deutsche Bank 12%, the shipping company Danos at 6%, Acadian at 4%, and one of the largest insurance companies in Israel owns 2.6%. Let's look at their financial ratios. Their PE ratio is 2.2. That is correct. It is 2.2. I know it's hard to believe. I'm not sure if I've seen a PE this good before. That's stock price over earnings per share. That means investors are paying $2.20 for $1 of earnings. The median in the market is 20. The average is 30. Their price to sales is 0.8, so that means their revenue is higher than their market cap, and their price to book is 2.3. That's stock price over book value per share. Let's look at their non-current assets. The value of their vessels, according to their balance sheet, is $2.3 billion. Their containers are worth $1.3 billion. They have $68 million of intangibles from their acquisitions and some other smaller items. They have an amazing return on invested capital, over 100%. They can cover their interest payments 25 times. ROE of over 100%. They have a good current ratio of 1.6 and a good quick ratio of 1.5. Let's look at their current assets. $107 million of inventory. $1.2 billion of receivables. This is how much money other companies owe ZIM, and $2.5 billion of cash. Let's look at their current liabilities. $1 billion of payables. This is how much money ZIM owes other companies. $600 million of contract liabilities, and $770 million of leases. They generated $3.6 billion of free cash flow in the trailing 12 months. They have $1.5 billion of working capital, and they have $1.2 billion of annual dividend payments to pay. So they're really well funded. They have nearly $4 billion of funding. The best way to look at ratios to compare them to companies in the same industry. There are 34 companies in the same industry as ZIM, and these are the top 20 by market cap. ZIM spends a lot more on CapEx than the average company. They're less leveraged than average. Their dividend is through the roof, much bigger than average. They generate more free cash flow than any company in this industry. Their market cap is the largest. Their price to book is worse than average, but their PE, price to free cash flow, and price to sales are much better than average. They generate more revenue than the average company. Their 3-year annual growth rate is 10%, the average is 12%, and their ROA and ROE are extremely high. So to summarize, I have them trading at a 75% discount. The stock has gone up a lot since they IPO'd, but it still seems like there's a lot more upside. But a lot is dependent on the price of the rates in the market. The more ships in the market, the lower the rates become. And the less ships in the market, the higher the rates are. So if other companies in this industry start buying more ships or new companies pop up, that could lower the rates for companies like ZIM can demand, which will squeeze out their profits. There is some concern with inflation. There's also concern with the demand for the products the vessels ship. So there's a lot of external factors that can affect the company's stock price. But I really have no way to predict these types of things. I just try to look at the financials and see if the stock is over or undervalued. Of course, anything can happen externally, but based off of their financials, it just looks amazing. I rank their free cash flows, revenue, and ratios 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.